Boom, Pitbulls, what is up? If you're watching this on YouTube, please hit that like and subscribe button. Alright, so we're going to dive into why I choose the options that I choose personally according to my strategy, and then you're going to be able to come up with better justification for why you're trading the options that you're trading based on your strategy. So we're going to do that by using the Greeks to start off with. So I'm going to go boom. We're going to use Wish as the example, alright? Trade options. We'll go to August 20th. Alright, you just see I got a couple of these babies. Dice roll, we got earnings next week. So let's start with the one that I'm holding. Actually, I probably wouldn't buy this now. It's probably dropped a little bit since I bought that. I'd probably go a little deeper in the money right now. I'd probably go, say, $8 if I was buying an option for my strategy. Personally, I like to buy deep in the money calls, and I'm going to show you why. Alright, so if you look at the Greeks, we're going to dive into the first Greek only right now. I'm going to do a video on each one just to try and keep it as simple as possible. So with Delta's a measure of the rate of change in the options price for every $1 that the underlying moves. So with Wish specifically, you see Wish is at $9.90. Let's call it $10 to make this super easy. Okay, so if this option had a delta of 86.86, you can round and we'll call it 0.87. All right, so we don't have to worry about the other two numbers. Keeping it simple is the goal here. All right, so if Wish had a delta, if this $8 call for Wish had a delta of 87 cents, for every dollar that Wish increased, the options value would go up 87 cents. Now it gets a little more complicated once we dive into gamma, because gamma is going to measure the rate of change for delta. That gets a little bit more complicated, which is why I wanted to start with delta, try and keep it simple here. Okay, so if Wish was $10 and it went to $11, and our options value right now, let's just pretend we got it close to the ask at $2. That'll make it easy, right? So Wish is $10, our option, the $8 option costs $2. And then Wish goes to $11, what would our $2 option be? If you said our $8 call option would be worth $2.87. Okay, pretty simple. So when you're using this strategy and you're looking at an option, sometimes I'll have people messaging me and be like, hey, the price of the underlying, the equity, if Wish is going up and my option's not going up that much. Well, that's because maybe time decay is hurting you worse than Delta's helping you. So that's why we want to use these Greeks. I'm going to try and make it as simple as possible, so please comment below anything that doesn't make sense here, any questions that come up because of what I'm saying. I'm trying to keep this simple, but starting with Delta is a change in the option price for every $1 that the underlying equity increases. So if the underlying goes up $1, the option value goes up whatever that delta is. So let's dive into a different option. So that's how I like to buy in the money call options and sell out of the money call options. So let's look at an out of the money call option, then I can show you why that makes sense to do. So let's go with the $11 call. And in order to get this to pop up too, if you're using Robinhood, I'm using Robinhood because everybody uses it and always asks me to show things on here. It's also really simple. So that where it says bid ask with the drop down, that's what you're going to click to get this menu to pop up. And that's where you're going to see the Greeks at the bottom. Now you see the delta for the $11 call is 33 cents, meaning that if today Wish went up $1 and I own the $8 call for $2, Wish went up from $10 to $11. Now my $2 call will be worth $2.87. Now this is negating all the other Greeks. This is if we're only thinking about Delta, which is what we're going to do right now to try to keep it simple. Like I said, Gamma affects Delta, but we're not going to go there yet because it's a little less important right now, especially if you're doing quick in and out trades and looking for the right option to buy based on your strategy. So with Delta, let's say we sold the $11 call, Wish went up to $11. Delta, this call option that we sold for 40 cents would only be worth 70 cents now, or 73 cents. We sold it for 40, now it's worth 73. Okay, but the one we bought for $2 is now worth $2.87. So even though we bought in the money and we sold another option off of it, the one that we sold, the value of it is not going up as much as the one that we bought, which is what we want. We want the value of that one to go down and the one that we bought to go up. So this gives it room to do that, and that's why I like to trade at a high delta. I trade in the money, I buy in the money calls, sell out of the money calls whenever I'm creating call spreads. And that's what works for me. That's a strategy that works for me. You got to decide what works for you. Depends on your risk tolerance, depends on your budget. You might not be able to afford the deeper in the money calls. You might have to play a little bit out of the money, and then you might just want to trade, in and out. That can also work in your favor. Let's go way up here. Let's pretend like, see if this $12 call, right? So a $12 call is only 25 cents. And it has a delta. We're going to round it to make it simple of 0.22, all right? So let's say you just want to do this as a swing trade overnight, and you think that Wish is going to go off overnight, or it's got earnings coming up. You think it might rocket, all right? You don't want to risk the $2 per share, or $200 is what the contract would cost you for the $8 option, because maybe you have a smaller account. You just don't want to risk that. You don't believe in Wish that much. It's more of a dice roll for you. In that case, you could go buy the $12 call for 25 cents per share, or $25, but it's an eighth of the cost of the $8 call. And then with a delta of 0.22, even if Wish goes up $1, you dang near doubled your money. It's actually doing better. I mean, if you dropped $100 on that, or if you dropped the same amount of money that it cost for one $8 call, and that happened overnight, you would have made $87 trading that $8 call in an overnight swing. Or if you would have spent $200 on $12 options, even though it has the lower delta, because the delta price is almost the same as the price as the option. That's why, because it's 25 cents to buy the call, and it's 0.22. So you're gonna almost double the value of that option when it goes up $1. So if you were trying to do a quick double up on $200 and you had some strong belief in this, that might be the way to do it. Now, it's a much, much, much riskier way to do it. And so that strategy doesn't really make sense for me. Sometimes it does. Sometimes I do take those kind of risks, and I like to do that, but not with this play in particular. Well, kind of. You'll see where I'm at in this play. I'm more at the money. So I'm kind of in between. I don't want to risk as much. But I think if it is going to move, I think it's going to be a big move. So I think I'll be all right just at the money with a little bit of time on it too. So the strategy is different for every play, but delta is definitely one thing that you want to take into consideration when buying and selling options. So comment below if any of this didn't make sense, or if you have any questions, need any help. I'm here for you. All right, peace.